Happy Friday. It is February 13th, 2026. And if you've been watching the markets this
A
morning,
lot of green.
a lot of green, exactly. But then you scroll down to the geopolitical headlines and it's all red. And if you're looking at your grocery bill, well, you're probably just closing your eyes and tapping the card.
It really is a split-screen reality right now.
It feels schizophrenic. And to help us make sense of this, we are diving into the big one today. We have the United Nations World Economic Situation and Prospects 2026 report on the virtual desk.
And this is not light reading.
No, it's dense, it's bureaucratic, and honestly, it's ringing some very specific alarm bells that we need to listen to.
It is, and it's interesting you call it a split screen.
Right.
Because the report essentially frames the entire global economy as a paradox. That's really our mission for this deep dive, to decompose and distill this tension.
Okay.
We have an economy that is simultaneously fragmenting, falling apart at the seams geopolitically, and yet, strangely, cooperating just enough to keep the lights on.
Fragmentation versus cooperation. That feels like the defining friction of the decade. But before we get into the heavy geopolitics, let's set the baseline. What's the actual pulse of the global economy right now? Are we growing? Stalling?
We're limping. The UN projects global growth at 2.7% for 2026.
Which, historically speaking, is mediocre. It's not a recession, but it's certainly not a boom.
Right, it's sluggish. But that headline number, it really hides the pain. The report is very clear that living standards are stagnating.
So even with steady growth.
Exactly. For the average person, and we'll get into the psychology of this later, it doesn't feel steady. It feels fragile. You have high debt, you have climate shocks, and you have this looming question of whether the massive tech boom we're seeing is actually a bubble waiting to burst.
I want to put a pin in the tech boom because the numbers in here regarding AI and energy costs are absolutely wild, and we need to spend some time on that.
For sure.
But let's start with the fragmentation. The report uses the word sobering to describe 2025. That's diplomatic speak for it was a disaster.
It was a rough year for the global order, no doubt. The report focuses heavily on the shift in trade policy, specifically from the United States. We saw a pivot to protectionism that moved beyond just, campaign rhetoric into hard policy.
We're talking about the tariffs.
Significant ones. The data shows the average effective tariff rate in the U.S. climbed from about 2.5% in 2024 to an estimated 15% by late 2025.
That is a massive jump. Going from 2.5% to 15% isn't a tweak. That changes the fundamental calculus of doing business across a border.
It effectively ends the era of cheap, seamless global trade. And the report notes that while we haven't seen a total collapse of global commerce, these strategic rivalries are eroding the rules-based order. Creates friction.
And in economics, friction costs money.
Always. But what's even more concerning in the text is where the government money is flowing in response to this friction.
I highlighted this line too. Investments in war rather than investments in peace. It's the classic guns versus butter debate. But the UN is saying the scales have tipped way too far toward guns.
That's the reality. Rising military expenditure is explicitly mentioned as diverting scarce resources away from social spending. I mean, if you're a government with a finite budget, and let's be honest, debt levels globally are already screaming high.
Right.
Every dollar you spend servicing debt or buying military hardware is a dollar you aren't spending on education, healthcare, or green infrastructure.
It creates a crowding out effect.
It does. It leaves the domestic economy brittle because the safety nets are being neglected to pay for the walls.
So we have walls going up, tariffs rising to 15%, and money flowing into defense rather than development. That's the fragmentation side of the paradox. But you mentioned cooperation. Where is the hope? Because looking at that picture, I'm struggling to find it.
Well, that's the tension. While the loud politics are all about conflict, the quiet technocracy is actually, stitching things together. The report makes a big deal about this Sevilla commitment from 2025.
The Sevilla commitment, I feel like that didn't get enough airtime when it happened. It sounds like a treaty, but it's really about finance, right?
It's about preventing a domino effect. The international community realized that with interest rates where they are and climate shocks getting worse, a lot of developing nations were facing liquidity crises.
And if they go bust, the contagion hits everyone.
Exactly. So Sevilla is a renewed agenda to scale up development finance.
And this includes those state contingent debt instruments, which, if I understand it, is basically a pause button for national debt.
That's a great way to visualize it.
Yeah.
Imagine you run a small island nation, a hurricane hits and wipes out 30% of your GDP overnight.
Okay.
Under the old rules, you still have to make your debt payments the next month. So you have no money to rebuild because you're paying foreign creditors.
Which practically guarantees a collapse.
It pushes you into a death spiral.
Yeah.
State contingent debt instruments change the contract, they say. If a defined disaster strikes, debt payments pause for 2 years. It gives the country breathing room to recover without defaulting.
So it's a huge shift.
It's a massive shift in how we handle sovereign debt. It essentially makes the financial system more resilient to climate change.
Which I guess dovetails with the other bright spot you mentioned, COP30 and the BALAM package.
It does. We see these climate commitments every year, but this one seems to have teeth. It has specific mechanisms. They've committed to tripling adaptation finance by 2035.
That's a big number.
It is. But more interestingly, they introduced a just transition mechanism.
Which addresses the labor market.
Yes, it acknowledges a hard truth. Moving to green energy destroys jobs in old sectors. If you don't support those workers, you get political backlash, populism, anger, which leads to more fragmentation. So the just transition is about funding that social bridge to keep the voters on board.
So the takeaway on the macro level is fascinating. The headlines scream trade war, but the backrooms are signing deals like Sevilla and BALAM to keep the global ship from actually sinking.
That's the tug of war. The politics are pulling us apart. The survival instinct is pulling us together.
Okay, that's the view from 30,000 feet. I want to bring this down to the ground level, the grocery store aisle. Because the report has a section on inflation that I found to be one of the most intellectually stimulating parts of the whole document.
Yeah.
It deals with the psychology of price stability.
This is where the report moves from math to behavioral science. They tackle the question of why inflation feels so sticky in our heads, even when the data says it's cooling.
Right, because the official number, global inflation, is projected to slow to 3.1% this year. That's not terrible. It's manageable. But if I ask my neighbor, they'll say prices are out of control. Why is there such a massive disconnect between the spreadsheet and the sentiment?
The report introduces a concept called state-dependent expectations.
State-dependent expectations. Let's decompose that.
Think back to the 2010s. Inflation was low and boring. When you bought a gallon of milk, you didn't really look at the price. You were inattentive because you assumed the price was roughly the same as last month.
Right. You were in a low-attention state?
Autopilot mode.
Right.
Just swipe the card and move on.
Mm-hmm.
But when we hit that massive inflation surge a couple of years ago, we all woke up. We shifted state. We became hyper-aware of every price tag. The report argues that once consumers enter this high-attention state, it is incredibly difficult to switch it off.
So our brains are still scanning for danger, even if the danger is fading.
Exactly. We are essentially traumatized shoppers. We expect prices to go up, so we act like they will. And it's not just shoppers, it's businesses too. The report notes that in the U.S., the dispersion of inflation forecasts—
basically the disagreement among experts on where prices are going.
Right. That widened again in 2025.
Mm.
And that uncertainty is toxic. When companies are unsure, they keep prices high as a buffer. When workers are unsure, they demand higher wages just in case. It becomes, a self-fulfilling prophecy.
So even if the supply chains are fixed, the fear of inflation keeps inflation alive.
Attention is a one-way street. Once you start looking at prices, you don't stop.
There's another term they use that I hadn't seen formalized before, and it really highlights the inequality of this moment. Cheapflation. It sounds like internet slang, but this is the UN using it seriously.
It's a critical concept for understanding why the poor are angry, even if the GDP is growing. We usually look at a single inflation number, say 3%. But that number is an average. Cheapflation describes the phenomenon where prices for lower quality budget goods rise significantly faster than high-end goods.
So the bottom shelf is getting more expensive faster than the top shelf.
Much faster. The report cites data from the UK showing that prices for bottom-run budget brands rose by more than 30%. Meanwhile, premium top-tier products rose by less than 20%.
That is a massive gap, and the implication there is brutal for low-income households because they lose their primary defense mechanism.
You nailed it. Usually if steak gets expensive, you buy ground beef. If premium pasta goes up, you buy the store brand, you trade down.
Sure.
But if you are already buying the store brand and that price goes up by 30%, you have nowhere to go. You are at the floor.
So the effective inflation rate for a poor family is higher than for a rich family.
Significantly higher. The wealthy might be annoyed that their luxury goods are up 15%, but the poor are facing a 30% hike on survival basics. It creates a divergence in how different demographics experience the same economy.
It explains why the aggregate data can look okay, but the social mood is furious.
Exactly. And this gets even worse when you look at developing regions. The report links food security in Africa and Western Asia directly to urbanization.
So the very act of moving to a city makes you vulnerable to this cheapflation.
This is the structural trap. As populations in Africa and Asia move to cities, they stop growing their own food. They become dependent on markets, and specifically on imported grains.
And as we just established, the global trade system is fragmented, tariffs are up, supply chains are rocky.
That creates the perfect storm. You have a city dweller in a developing nation who is relying on a global food system that is breaking down. Weak infrastructure plus climate shocks plus trade wars equals massive price spikes in urban centers.
And the report mentions the health impact of this. It's not just economic, it's biological.
It is. They found a correlation between these price surges and an increase in stunting and wasting in children. Families aren't just cutting back on treats, they are cutting back on nutrients. They're switching to empty calories because that's all they can afford.
Which brings us back to why the Sevilla commitment and that safety net are so important. It's not abstract finance. It's about keeping people fed when the market fails.
It puts the stakes in perspective. This isn't just about stock portfolios.
Speaking of stock portfolios, let's pivot to the other big story of 2026. You can't talk about the economy without talking about the technology that is supposedly going to save us or bankrupt us. Artificial intelligence.
The shiny trillion-dollar object.
The report seems incredibly conflicted about AI. On one hand, it acknowledges that this is where all the capital is going. It's the engine.
It is the primary driver of investment in the US and Europe right now. And the narrative driving it is productivity. We have shrinking workforces in the West, aging populations. So the logic is that we need AI to make us more efficient just to maintain our standard of living. That's the bull case.
But then comes the sobering reality check, the bubble. The report points to the CPE ratio for the S&P 500.
The cyclically adjusted price-to-earnings ratio. It's a long-term measure of how expensive stocks are relative to their actual profits. And right now, it has climbed well above its long-term average.
Meaning stocks are expensive.
Very expensive. The concern from the UN authors is that we are in a hype cycle. Investors are pouring trillions into AI, infrastructure chips, data centers, models, expecting these magical future profits that haven't fully materialized yet.
It feels a lot like the late 90s dot-com boom. Everyone knew the internet was the future, but they still lost their shirts betting on it too early.
The parallels are strong, and the report warns of a disorderly adjustment.
Which is polite economists speak for crash.
A massive crash.
Sure.
And because these tech companies now make up such a huge percentage of the total market capitalization, if they sneeze, the global pension funds catch a cold. A tech crash isn't contained to tech anymore. It's systemic.
But there is another cost to AI that I think gets overlooked, and the report shines a spotlight on it. We think of AI as digital, existing in the cloud, but the cloud is made of metal and silicon, and it eats electricity.
This was the most shocking statistic in the entire document for me. Box 5.2, they did a deep dive into the hidden costs of data centers.
Lay it on us.
In parts of the United States with high concentrations of data centers, wholesale electricity prices were up at 257% in 2025 compared to 2020.
Wait, 257%? That is nearly tripling the cost.
In just 5 years, yes.
How is that even possible? I thought renewables were getting cheaper.
They are, but data centers are voracious. They run 247, they need massive cooling, and they're expanding faster than the utility companies can build power plants. So you have this bidding war for electrons.
The data center is competing with the local factory and the local household for the same grid capacity.
Exactly. So while AI might be making it cheaper to write code or generate an image, it is making it drastically more expensive to turn on the lights in your house if you live near a server farm.
It's a redistribution of resources.
And it raises a massive question about sustainability. We are trying to electrify our cars and our heating to fight climate change, right? But AI is coming in and sucking up all that new green capacity and then some. It's actually keeping fossil fuel plants online longer just to meet the demand.
It's another paradox. The technology that's supposed to optimize our energy usage is the one driving the energy crisis.
It suggests that the productivity miracle of AI comes with a very high physical price tag that we haven't fully accounted for yet.
So if we recap the landscape so far, we have a trade war raising costs on goods. We have cheapflation hurting the most vulnerable. We have an AI bubble that is driving up energy costs. It feels, well, volatile is probably the nice word for it.
Volatile is accurate. But we shouldn't end on doom.
Right. The report does have a way forward segment, and it talks about resilience and reorganization. This is where we answer the big question. Is globalization dead?
The short answer is no, but it is mutating. The report suggests that trade isn't disappearing, it's rerouting.
So if the U.S. puts up a 15% tariff wall, goods don't just stop moving.
They flow around the wall, like water around a rock.
That's a perfect analogy.
And we are seeing a massive surge in South-South trade.
Meaning trade between developing nations bypassing the West entirely.
Correct. For example, China is facing hurdles in the U.S. and Europe, so they are aggressively expanding exports to the ASEAN countries and to Africa. They are building new supply chains that don't rely on the American consumer.
This aligns with the rise of these regional networks the report mentions, the AFCFTA in Africa and RCEP in Asia.
These are the shields. The report frames these regional trade blocs as defensive mechanisms. If the global system is hostile, if the U.S. is protectionist and Europe is stagnant, then you trade with your neighbors.
It creates an internal market.
A massive internal market that is somewhat insulated from Washington or Beijing's mood swings. It's a shift from global integration to regional clusters.
That is the key trend for 2026. The world is clustering.
There's also a specific mention of critical minerals, the stuff we need to build the batteries and the chips.
Chile, DRC, Zambia.
The heated competition. Everyone wants the lithium and the cobalt. The report warns that this rush can prey on weak governance, leading to corruption and environmental damage. But the opportunity, the way forward, is value addition.
Meaning don't just dig it up and ship it out.
Right. Don't just sell the raw rock. Refine it. Build the battery component locally. The report argues that for these resource-rich countries, 2026 is the year to demand more of the value chain. If the world is fragmenting, you have leverage. Use that leverage to build an industrial base, not just a mine.
So we've covered a lot of ground today. We've looked at the breakdown of the old order, the tariffs, the fragmentation. We've looked at the psychological scars of inflation and the brutal reality of inequality. And we've looked at the energy-hungry AI bubble.
And the regional reorganization.
Right. So if I'm a listener, maybe I run a business, maybe I'm an investor, maybe I'm just trying to plan my life. What is the synthesis here? We promised to distill this. What is the one thing I should be thinking about?
I think it comes back to that idea of clustering.
Go on.
For the last 30 years, the dominant strategy for everyone, countries, companies, individuals, was go global. You wanted the cheapest supplier in Vietnam, the biggest customer in America, the capital from London. It was a seamless web.
Man, that web is tearing.
It is reforming into knots, into clusters. So the provocative thought for the listener is this. Are you diversified enough to survive the breakup?
What does that mean practically?
Well, if your business relies entirely on a single supply chain that crosses a hostile border, you are vulnerable. If your investment portfolio is betting entirely on U.S. tech stocks staying at a KP ratio of 35, you are vulnerable. The world is moving toward regional resilience. The question is, are you doing the same?
Are you reclustering? That is a heavy question.
It's the defining question of the late 2020s. We aren't going back to 2019. We are moving into a world of blocks. You need to make sure you aren't stranded in the middle.
I think that's the perfect place to leave it. The report is the World Economic Situation and Prospects 2026. It's a map of a fragmented world, but if you know how to read it, you can navigate the cracks.
Always a pleasure to decompose the chaos with you.
Thanks for listening to this deep dive. Keep your eyes on the headlines, but keep your mind on the underlying trends. Stay curious, stay adaptable, and we'll catch you on the next one.